Hi, I'm Sam Slater from Fund Calibre, and today I've been joined by Ben Peters and Chris Elliott, co-managers of the TB Evenlode Global Income Fund. Hello.
Hello.
So if we perhaps start with the question that's on all investors' minds at the moment, and that's dividends. How have the companies that you invest in, how have their dividends held up? And as a consequence, how have the dividends of the fund held up, please?
Yes, well, clearly with the pandemic, it's been a slightly more difficult time for some companies, those that are more economically exposed, and that has an impact on some dividends. I think in the market, you're seeing estimates of dividends being reduced by about a quarter globally and more in the UK. Even though Global Income Fund has fared better than that, we're looking at probably a reduction in the dividend of about 13% this year. Over 80% of the companies have announced no disruption at all to their dividends, and that's because they're in relatively economically stable sectors with a lot of repeat purchase characteristics, whether that's from media companies or consumer goods, which have had to adapt to the pandemic, but have been able to carry on more or less business as usual. But there are a subset of companies that are more economically exposed, like advertising companies, recruitment companies, and they have seen some impact on their dividends. So we're looking at around a 13% reduction year on year this year.
That's a lot better than the market, so that's some good news for investors, isn't it? And I've heard that you've split the portfolio into three different sort of segments as to how the companies have been impacted by the pandemic. Perhaps you could tell us a bit more about that.
Sure. So we've divided the portfolio into those three categories you mentioned. It's firstly to help us understand the difficulties faced and sort of categorise them according to those, but also to make sure that we're directing our attention to the right places and understanding the risks and opportunities that companies are facing. So our first category, as Ben referenced, is business as almost as usual. Now, no business has been unaffected by the current crisis, but this includes 2/3 of our portfolio, and that's really where we're getting the resilience from. These companies are relatively low disruption and may even have actually seen an acceleration in a beneficial trend. So you've got companies like Microsoft with the working from home trend. The second category we called the walking wounded. Now, these are companies which have experienced a significant disruption, probably in cash flows or earnings over the short term, and that's often due to a cyclical exposure or something we feel is very much temporary. Now, these companies in total account for about a quarter of the portfolio, and we believe that they'll be able to continue to invest heavily through the current situation and actually emerge in a much stronger position exiting the crisis. And that includes companies like Fuchs Petrolub, the German lubricants manufacturer. And it's really in that category that we found the best value and the best opportunities throughout the current situation. And then finally, we have severe cases. Now, these are companies where the total focus has really been on surviving the current crisis. And these are where we only got 6% of the portfolio, but we are really focused on what are the fundamentals and the financials of the business. So companies like CTS Eventim, which has a very large cash supply and reserves of cash that help it manage even when profitability falls sharply.
And have these walking wounded and the severe cases had an uplift from the recent vaccine news? Is there sort of light at the end of the tunnel for these stocks?
Yes, absolutely. And I think that in terms of the market price reaction, they've certainly seen the most benefit from the news of the two vaccines that seem to have good efficacy. But I think it's worth noting, actually, that this really is a case of sort of a rising tide lifting all boats. Actually, most companies have seen a benefit from the recent news as investors, I think, look towards the end of hopefully this current situation and onto sort of more normal times ahead. But certainly those that have been more impacted have seen a better market price reaction at least. And I don't think anyone's calling the sort of end of the crisis quite yet, but there's certainly light at the end of the tunnel.
And this one's just marking its third anniversary. Over the past 3 years, has there been any regions that have become more interesting, perhaps in terms of dividend growth? Japan, maybe, or somewhere else?
Sure, and we're very much focused on the long term. So in terms of regions, we are relatively neutral, but we're always looking for new opportunities. We have been to Japan a couple of years ago just to really understand the corporate governance out there and to see whether attitudes towards paying dividends were changing. I think the answer is yes, but slowly. So we're interested there. In terms of other regions that have become more interesting, actually America is starting to see a number of companies start to pay a dividend. One company that we added to the portfolio about a year ago was eBay, and that was very much on them deciding to start paying a dividend.
Which stock over the past few years has been your biggest success story?
Yeah, that's a very, very, very interesting question. So the biggest contributor to the fund's performance over the 3 years that we've been managing it now is Microsoft. And Microsoft's a really, really interesting case study because more recently it's been certainly a beneficiary of more home working through its Microsoft Teams and in line with Office 365. But actually there's a much longer term secular growth story there with the move to cloud, with its Azure cloud operating system. And that certainly has had some good traction over 3 years we've been managing this fund, but over the longer term as well. And I think that's got a very bright future. But I think it has been a broader range of companies that have contributed to the fund's performance over the 3 years, and from a quite diverse set of sectors. So there's technology in the form of Microsoft, but there's also media from Wolters Kluwer, healthcare with Roche, and consumer goods with Procter & Gamble. So it really is a sort of broader set of companies that have driven the fund's performance in a positive way. It would be remiss of me to not note that we haven't got everything right, and not everything has gone our way. And certainly some of those companies that have been more exposed to the cyclical downturn and the shock of the pandemic more recently have been negative contributors, more recently, but longer term as well. And also those companies where you've had perhaps that, but combined with having some debt. And whilst we certainly can't control the arrival of a pandemic, we can control the strength of the balance sheets within the portfolio. And it is those companies that have had weaker balance sheets where we've seen a bit more difficulty. So in sort of beer companies and in the US technology company Sabre, for example, at the start of the pandemic. So whilst it's good to note the successes, but we should also be honest about where we haven't quite got things right.
That's great. Thank you very much. And if you'd like to find out more about the TB Evenlode Global Income Fund, please go to fundcalibre.com.